What's up, everyone? It's Jonathan here. So I've done intensive research on trying to figure out how to get the perfect credit score. Even though I've been close, I haven't necessarily met the mark yet. Your credit score is very important because it affects how much home you could buy, how much interest you have to pay, where you could rent, what kind of car you could drive, and even in some cases, what kind of job you could get. So if you watch till the end of the video, I'll go over step by step how I get the perfect credit score, whether you're repairing your credit or you have no credit at all. I'll also cover the factors that determine your credit score as well. So without further ado, let's get right into the video. So your credit score is basically rated on how well you're able to pay back debt. It's rated by a score anywhere from 300 all the way up to 850. Each credit bureau uses different information to determine your credit score, so they tend to differ slightly between one another. In the United States, there are three major credit bureaus: Equifax, TranUnion, and Experian. So these credit bureaus use 5 different factors to determine your credit score. The first and most important factor they use is payment history. It makes up about 35% of your credit score, and it's the main factor that they use when determining your credit score. Payment history is a record of how well you're able to pay your bills on time. Payment history is calculated by dividing the amount of on-time payments you made by the amount of total payments. So for example, if you had an auto loan where you had 60 payments and you were on time for 59 of them and late once, divide the 59 on-time payments by the 60 total payments to determine on-time payment rate. Most bureaus like to see 0 missed payments. So just having 1 missed payment can tank your credit score pretty hard. So it's very important to keep track of all the bills that may possibly affect your credit. So the obvious ones are credit card bills, auto loans, student loans, mortgages. But some unobvious ones that people tend to overlook is sometimes utility bills will report to your credit. Sometimes cell phone bills will report to your credit as well. So it's a good thing to keep in mind when you're paying bills to make sure that those bills get paid on time. If you do have a missed payment on your account, it's not the end of the world. You can usually mitigate that by just having more on-time payments. So the longer you hold a credit account open or a mortgage open or whatnot, you'll accumulate more on-time payments, which will increase your on-time payment rate, which will help your credit score out. As a side note, for those of you who are in school, I've noticed that sometimes with certain student loans, they'll actually put you in forbearance while you're going to school. And while you're in that forbearance period, you're technically making $0 payments. So you may have already been building your credit without you even knowing. The second factor that makes up your credit score is credit utilization. Credit utilization is the amount of credit that you use compared to the amount of credit that is extended to you by a credit card issuer. So for example, if you had a $1,000 credit limit and you use $300 of the limit, you now have a 30% credit utilization rate. Credit bureaus like to see credit utilization rate either at or below 10%. When you're first starting off, the best way to avoid this is to make sure that you pay your credit cards in full every month and not carry a balance. Usually if you're paying your cards every month, the credit utilization won't stick to your account. So even if you are using like 90% of your credit, because let's say you have a really low credit limit, it'll probably have a negligible effect on your credit. It's important to note that this only applies to revolving credit accounts like credit cards and doesn't apply to installment loans like auto loans or mortgages or student loans. The third most important factor that go into determining your credit score is your credit history. Bureaus look at 2 things when they're determining this category. They look at the age of your oldest account. They also look at the average age of all your credit accounts. So let's say you had 2 credit accounts. One you opened 3 years ago and the other one you opened a year ago. Your average credit history would be 2 years. And also it's important to note that paying off any installment loans like student loans or auto loans or mortgages will actually cause your credit score to go down, because once those accounts are paid off, they get closed. So they don't count towards your credit history. The fourth factor that they use to determine your credit score is your account mix, and that makes up 10% of your credit score. So basically, when it comes to credit, you have 2 different types of accounts. You have revolving accounts like credit cards, and then you have installment accounts like auto loans, student loans, mortgages. Bureaus like to see both a mix of revolving debt and installment loans. because it shows that you're able to manage both types of loans. So the fifth and final factor that they use to determine your credit score is the amount of hard credit inquiries you have in your account. This makes up to about 10% of your credit score. So anytime you apply for a new loan or a new credit card, the issuer or the lender will run a hard credit inquiry to determine if you're eligible for the loan or for the credit card. These hard inquiries are reported to the credit bureaus, and the credit bureaus don't like to see you have too many of these inquiries over a short period of time. Hard inquiries usually have no effect to your credit score after a year, and usually tend to drop off your credit report after 2 years. Now, since we've gone over the factors that determine your credit score, let's go step by step how to build a perfect credit score. So the first step to building a perfect credit score is to open a Credit Karma and Experian account. These accounts allow you to track your TranUnion, Equifax, and Experian credit scores. Like the saying goes, you can't improve what you can't measure. So you want to open up both these accounts. They're completely free, and you want to check your credit every about 2 to 3 weeks, and making sure there's no errors on your credit report, and also being able to know what your credit score is. After you've opened the Credit Karma and Experian account to be able to track your credit, the next step is to open your first credit card. So a secured credit card is basically a card that is backed by a deposit you give to the bank. So for example, let's say you wanted to get a secured credit card with a credit limit of $1,000. You would go to the bank and you'll ask for a secured credit card, and what they'll ask you for is $1,000, and then they'll give you this credit card. And basically what the $1,000 does, it acts as a deposit. So if you were to ever default on your credit card, the bank will just take your deposit or take whatever amount of the deposit they need to pay your outstanding balance and then give you the rest of the deposit. Recommendations on secured credit cards. My personal preference is the Discover It secured card. You get 2% cash back at gas stations and restaurants, and 1% cash back anywhere else you spend it. It's one of the few options for secured credit cards that actually give you cash back as well. Now, if you already have credit, but you're just trying to rebuild your credit score, then I recommend you getting the Apple credit card. The Apple credit card gives you 3% cash back on Apple purchases, 2% cash back on any using Apple Pay, and then 1% cash back with any purchases made using your card. They also offer 5% categories as well, but they're very off and on. It's a good second option if you have a credit score over 580. I've heard stories of people with even 550 credit scores getting approved for them. So Apple themselves they haven't put out a exact guideline of what credit scores they take, but if you have a credit score somewhere in the range of 600, it's not a bad choice. Now, if you don't have an iPhone, then I would recommend that you go back to Discover a secured card. So step 3 is to use your credit. So when you use your credit card you have now, you want to keep the credit utilization rate under 10%. So that means if they give you a $2,000 credit limit, you shouldn't carry a balance more than $200 on your credit card at any time. Make sure you use it at least once for every billing cycle, even if it's just going to the neighborhood convenience store and buying a pack of gum. You need that consistent use to be able to build your credit score. Make sure to pay off your credit card balance in full at the end of each billing cycle. Try not to carry a balance, again, because it affects your credit utilization rate. And definitely at least make the minimum payments. If you don't make the minimum payments, then that will affect your on-time payment, which is, like I said, was the most important factor when it comes to determining your credit score. So usually after about 6 to 8 months of responsible, consistent use, your secured credit card issuer will then turn your secured card into an unsecured card. They'll also send you back your deposit that you made for the secured credit card. Now, usually this happens automatically, but sometimes you do have to call the credit card issuer and ask to do it. Most of the time they will. Sometimes they will not, and usually it's because you have some kind of issue on your credit score. So if they refuse to issue a unsecured credit card, then you should ask them for what reason will they not issue you an unsecured card. So after you've now turned your secured card into unsecured card, or even if you went the Apple card route, you want to open up another account to try to lower your credit utilization even more if possible. So if your credit score is still below 700, I would recommend either getting the Apple card are getting a Capital One credit card. In my experience, I've noticed that Capital One cards tend to give you higher credit limits than the Discover cards. So if you do already have a Discover card, or if you're choosing between Discover card or Capital One, I would recommend getting the Capital One card, especially right now as you're trying to build your credit score. So if you're interested, I have a link down below for the Capital One Quicksilver card. It gives you 1.5% cash back on every purchase. The sixth step is to request a credit limit increase every 6 months from every one of your cards. This will help further decrease your credit utilization rate. So after you've had your credit score for a while, eventually you'll reach the point where you get to a 700 credit score. So once you get to a 700 credit score, you'll have basically an unlimited choices of credit cards you can choose from. So to get the perfect credit score, you just continue to repeat opening up new credit cards, asking for credit increases, paying your bills on time, and just responsibly using credit overall. So here's some important takeaways. First important takeaway is to start building your credit score immediately. It's going to take some time to build a perfect credit score. So you're going to want to make sure that you start as soon as possible because some of the factors are based off of time. Second thing is it's always best to keep credit accounts opened as long as possible. So even if you have a credit card that you signed up for that you don't really use, it's in your best interest just to keep it open and try to use a card maybe once or twice a year just to make sure that the account doesn't get closed on you. The third important thing to remember, anytime you're offered a credit increase, always take it. It never hurts to have more credit available to you. Fourth thing is to always make sure you're making at least your minimum payments every single month. On-time payment history is such a big factor of your credit score. Even if you miss one payment, that could prevent you from having a perfect credit score. Takeaway number 5, only spend as much as you can repay. Do not carry a balance or avoid carrying a balance as much as possible. Takeaway number 6, don't be afraid to use your credit score. Yes, hard inquiries do affect your credit, but there's no point of you having a perfect credit score if you're not using it to get favorable rates on loans. And generally when you're shopping for installment loans like auto loans, the credit bureaus will actually get all of your inquiries within a 14-day period and lump it as one inquiry. So if you are going to use your credit, you should try to run as many hard inquiries as you can in a short period of time. The last takeaway is once your credit score reaches about 760, there's no tangible benefit if your credit score goes any higher than that. You don't get any better rates, and having a credit score over that is really just more of a bragging right at that point. So thank you for watching. If you enjoyed this video, please hit the like button for the YouTube algorithm. It greatly helps out the channel. If you want to see more content like this, please hit the subscribe button and hit the notification bell so you get notified anytime when I post new videos. If you have any questions or comments, please leave them in the comment section down below. I try to reply to as many comments as possible. And thank you for watching, and until next time.